Welcome to the ultimate guide to WACC, cost of equity and cost of debt. In this video, we'll demystify these crucial financial metrics. Understanding WACC, cost of equity, and cost of debt is paramount for accurate valuation and excelling in finance interviews. These concepts are fundamental for careers in corporate finance, investment banking, and private equity, particularly for valuation interviews. They serve as a benchmark for evaluating projects, making informed investment decisions, and accurately valuing a firm. Mastering these metrics demonstrates your ability to bridge financial theory with real-world application. So, what exactly is WACC? It stands for Weighted Average Cost of Capital, representing a firm's average cost of financing. WACC is essentially the discount rate used to determine the present value of a company's future cash flows. It also represents the opportunity cost of capital, reflecting the return investors expect for taking on risk. In discounted cash flow models, WACC is the crucial discount rate for calculating the present value of future cash flows, providing a true valuation. Conceptually, WACC is the opportunity cost of capital, representing the minimum rate of return a company must earn on an existing asset to justify not investing it elsewhere. Imagine a financial seesaw, balancing debt and equity to manage risk and return. This visual helps grasp how WACC operates. Now, let's explore the interrelatedness of these metrics, often referred to as the, quote, golden rule. Cost of equity, cost of debt, and WACC are not isolated. They are fundamentally interlinked components of a company's financial structure. Increasing one, like debt, impacts the others due to changes in leverage and risk adjustments for equity holders. Visualize this with our seesaw diagram. Higher debt amplifies risk for equity holders, consequently raising the cost of equity. Next, we'll delve into how WACC is influenced by various key factors. Company size and involvement in emerging markets significantly affect a firm's weighted average cost of capital. One of the most intriguing aspects is the U-shaped WACC curve, illustrating the relationship between debt, the tax shield, and overall capital cost. Larger, more established companies typically have a lower WACC because they are perceived as less risky by investors. Conversely, firms operating in emerging markets face higher WACC due to country-specific risk premiums and greater economic uncertainty. Initially, increasing debt can lower WACC due to the tax deductibility of interest, creating a, quote, tax shield. However, beyond an optimal point, excessive debt increases the risk of financial distress and bankruptcy, causing WACC to rise, creating a characteristic U-shaped curve. Now, let's look at how broader macro factors influence WACC and its components. A rise in the risk-free rate, often proxied by government bond yields, directly increases both the cost of debt and the cost of equity. A higher equity risk premium, or ERP, increases the cost of equity, subsequently pushing up WACC as investors demand more compensation for market risk. Beta, a measure of systematic risk, means that more volatile firms, or those highly correlated with the overall market, will exhibit a higher WACC. The tax shield is a crucial factor. Only the interest expense on debt is tax deductible, effectively reducing the overall WACC. Changes in the risk-free rate, equity risk premium, and beta have a cascading effect, altering all components of a company's cost of capital. Crucially, a change in the tax rate only impacts WACC if the company has debt, due to the tax shield on interest payments. Here's a visual of a balance sheet, highlighting how debt and equity ratios are integrated into the WACC calculation. Now, let's put theory into practice with a concrete example. You can try a step-by-step calculation of WACC for a hypothetical company, using different debt and equity structures to illustrate. One can also try a sensitivity analysis, demonstrating how WACC changes with adjustments to the risk-free rate, beta, or even the tax rate. The hypothetical spreadsheet compares the cost of equity, cost of debt, and the resulting WACC under various scenarios, highlighting the impact of different assumptions. The hypothetical example and spreadsheet visual will clearly illustrate how these metrics change when we alter underlying assumptions. Finally, let's tie these metrics back to their critical role in discounted cash flow analysis. In DCF models, WACC is the fundamental discount rate used to calculate the present value of a firm's future free cash flows, ultimately determining its valuation. The cost of equity impacts equity cash flows, while the cost of debt directly affects the after-tax interest expense, both crucial for accurate valuation. Mastering these metrics is paramount, not only for investment decision-making and M&A analysis, but also for succeeding in competitive finance interviews. To summarize, WACC, cost of equity, and cost of debt are indispensable tools in financial analysis.